Brookfield Asset Management is kicking off its Investor Day this afternoon. Let's head downtown, where Dani is with the company's president and CEO of Renewable Power and Transition, Connor Teskey. Dani, take it away.
Matt, thank you so much. That's right. I am here with Connor, who is the Brookfield Asset Management president. Connor, thank you for having us. Wonderful to see you this morning.
Thank you for coming to our Investor Day.
So in your earnings, you released a letter co-signed by Bruce Flatt. In it, you said, "We believe AI infrastructure is one of the defining themes of the decade." You've already plowed about $100 billion into just digital infrastructure. So what does it look like to capture AI infrastructure? What is the road ahead for Brookfield?
Well, AI is a major theme across all of Brookfield. It's driving our power business, it's driving our digital infrastructure business. We're using AI to drive efficiency in our operating and industrial companies. But without a doubt, the biggest opportunity is the role that private capital can play in funding the significant build-out of AI infrastructure in this country and around the world. And we have built a platform that is dedicated to precisely this opportunity. It'll focus on building gigafactories on behalf of the hyperscalers and sovereign AI relationships around the world, and the supply chain and value chain that is required to fund that growth over the years and decades to come.
What is the timing like for this? Have you started to fundraise? Are you starting to look at deals already?
So we already have investors lined up for the strategy. We already have deals lined up, and we expect the momentum to continue, not only because of the opportunities that are in the market, but also the demand we're seeing from clients to get exposure to this theme.
There's a lot of demand, but I think there's a lot of people who have identified this too. I mean, you look at maybe non-traditional infra players, PIMCO and Blue Owl, for example. There was a report that they were looking to build out a Meta, or at least finance a Meta AI infrastructure. What does it mean for you, a very reliable face in infrastructure, to have more competition from maybe the non-traditional players?
So we like to think we play at a scale that very few can match. And our strategy and our platform will look to leverage our leadership in digital infrastructure, our relationship with the hyperscalers, our leading global power platform to provide a market-leading product that can help pull these projects out of the ground at attractive risk and adjusted returns. And despite the amount of inbounds and new entrants to the space, there is still more capital needed than what has entered.
What levels of capital are we talking about?
This is a multi-trillion-dollar opportunity that is going to run for years and decades to come.
So you're incredibly bullish on this, clearly, but it feels like you're also very bullish on other parts of private capital, be it real estate, be it private equity, be it credit. In 2024, at the end of that year, a lot of people were very bullish too. So what's different this time that gives you the confidence?
Let's start with real estate, because that's probably the one where we're seeing the greatest change in the market today. And the reality is the fundamentals for real estate have been incredibly robust for the last 12 to 15 months. But what's changed in 2025 is, one, the capital markets have opened up, become incredibly deep and receptive for real estate credit, and two, the sentiment has changed. And we are seeing that show up in transaction volumes and in valuations. We've monetized 4 times as much real estate this year than at this point last year. We've actually invested 2 times as much this year than at this point last year. And we're really seeing that momentum to continue. And we expect it will run throughout this economic cycle.
It's interesting because there are some pockets of investors being nervous. There's this wave of refinancing that's likely to come at the back half of this year in 2026. Even though you're very active, do you expect some pockets of distress as some of that refinancing happens?
There's a dynamic that's been true for a while, which is high quality real estate is significantly outperforming, and low quality real estate is struggling. That's showing up in who has access to credit. The other thing we're noticing is this real estate cycle is going to be in a more normalized interest rate environment, which means there will be less debt in the capital structure, and the market lends itself to those that can operate and create value in the assets. In the platforms we've been selling year to date, that is what has received premium valuations.
Just as you're thinking of the business as a whole, you mentioned rates. How much of this is just preparing Brookfield for what you expect, or if you do expect expect rates to come down significantly?
Rates are going to come down. Everyone sees that coming. But the reality is interest rates today are in a very normalized and constructive environment. If they're 25 or 50 basis points lower or 25 or 50 basis points higher, we don't think it changes the market backdrop, which is today very constructive for transaction activity. Year to date, we've monetized $85 billion worth of assets. That's one of our biggest levels of activity in recent years, and that's just because there is a constructive market backdrop. We don't think moves in rates change that.
Can we talk about the constructive market backdrop for credit? Because there's a lot of money chasing credit assets to the point where spreads have been so tight that even if you get moments of dislocation like April 2nd, they just snap back together. Is there a degree that there is just a structural force that maybe is causing some pricing that's not aligned with fundamentals, just because there's so much money going into the sector?
So private credit, which is driving these narratives, covers a pretty wide range of different types of credit. And there are no doubt some pockets where we do see a lot of capital flowing in and credit spreads very tight, maybe beyond what we're seeing in fundamentals. But in most pockets of private credit, for us in particular in real asset finance and in particular in asset-backed lending, we continue to see very attractive spreads because quite frankly, the suppliers of that market are still outweighed by the demand. So there are pockets within credit, but private credit's got several years to run.
What happens when there's even more demand coming from retail money, from wealth money? What does it do?
Well, retail and wealth money and 401k and retiree money, this is a natural extension for most alternative businesses. It certainly is for ours. And really all it is offering the same products and strategies that we have offered to institutions in the past, but structuring those to meet the needs of a new investor base, which is the individual. And while it will bring more capital into the sector across the major themes that we invest in around the world, there is still significant room for investment. There's lots of capital to be deployed.
Connor, I just want to end it on private equity. Again, another one of the areas where Brookfield's incredibly bullish. I know you have some big predictions of how much your business is going to grow. But just in the past 24 hours, we've heard from both Apollo and KKR saying that the smaller firms, that a lot of them are going to start shrinking, that they're not going to survive. There hasn't been enough fundraising, enough capital deployment, and enough returns. For the industry, are we about to see a really big wave of consolidation?
Two things there. Yes, we do believe there will continue to be consolidation in the asset management industry. There's no question about that. And we've been active in participating in that trend for a number of years now. Maybe taking your comments in the context of our private equity business. Our private equity business is actually our oldest business. It's been around for more than 20 years. It is our highest performing platform. And what's interesting about that business is it focuses on industrials and essential services that produce cash across the cycle. And what that's done is it's really insulated us from some of the narratives around meager returns of capital to LPs. Because we have cash flow, we can either up finance or even monetize even when markets are less than ideal. We've actually had a period of outsized returns distributions to our LPs. We think that drives our next leg of growth.
So you're going to maybe participate more in that consolidation is what I'm hearing if you're successful where others aren't.
We certainly expect to grow a lot in the near term.
Connor, thank you so much for your time this morning. I know you have a busy day ahead of it. We really appreciate it.
Thank you.
Matt, that is Connor Teskey, the president of Brookfield Asset Management. Very bullish, be it on private equity, real estate, and of course, AI infrastructure.
All right, excellent stuff. Dani, thanks so much. And thank you to Connor for joining us as well.